With the Federal Reserve aggressively raising interest rates, mortgage rates are on the rise as well. Sensing that home prices are in free fall, home buyers are now pulling back from the market. Home sellers are having to cut prices and offering more concessions to attract buyers. But, is this just a market correction? Or, is this a housing crash? What does this mean for the real estate market? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. With this backdrop, home prices will soon undergo a correction, Mark Zandi, chief economist at Moody's Analytics, told MarketWatch. Is the housing market crash of 2008 going to repeat itself? Crash is what happened back in the financial crisis. That was a crash, Zandi said. That's not what we're gonna have here, Zandi continued in an interview on CBS News. First-time buyers are locked out of the market, unable to afford rising mortgage rates, Zandi continued. At this time last year, the 30-year mortgage rate was 2.79%. Today, that rate is 5.66%. With buyers getting skittish and home sales falling rapidly, investors are waiting in the wings. The next thing to happen will be for house prices to adjust, Zandi explained. And we will see some price declines likely nationwide, Zandi continued. For hot pandemic boomtowns that were previously juiced up in the West and particularly Mountain West and South to the Southeast, Zandi added. Many of these real estate markets are seriously overpriced. San Jose, California is down 10%. Seattle is down 7%. San Francisco is down 7%. Los Angeles is down 4%. Denver is also down 4%. Zillow has sold its portfolio of properties at a substantial discount. Zillow stock is down almost 70% from its 52-week high. The CEO of Redfin has warned that his company is quickly selling off properties in its portfolio. Redfin stock is down over 75% in 2022. This the largest one-month price drop since January 2011. It was also the second worst July performance since 1991. The United States housing market is at a significant inflection point. Boise, Idaho is 72% overvalued. Austin, Texas is 67% overvalued. Ogden, Utah is 64% overvalued. Las Vegas, Nevada is 61% overvalued. Atlanta, Georgia is 58% overvalued. Phoenix, Arizona is 57% overvalued. Provo, Utah is 57% overvalued. Housing prices are falling in many U.S. cities, but how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. We will see some meaningful price declines, Zandi further noted. Zandi said, I predict large price corrections in once hot cities like Charlotte, Phoenix and Austin. Redfin CEO Glenn Kelman said, some of these markets already showing signs of turning. 70% of homes listed for sale in Boise had already had their prices cut, Kelman noted. Denver, Salt Lake City, and Tacoma followed, continued Kelman. Realtor.com said, 1 in 5 homes had their prices slashed, and the median listing price fell to $435,000. The median listing price of a house in the United States peaked in June at $450,000. Sellers are reluctant to sell their houses in a falling market according to Redfin CEO Kelman. Homebuilders are having to offer aggressive discounts. And they are canceling new building projects. Housing developers are seeing the pace of new home site visitors slowing down. Customers are canceling contracts. This could lead to the perfect storm that culminates in a foreclosure crisis. A housing crash could have devastating ramifications for tens of thousands of Americans. On the positive side, this could be an opportunity for first-time home buyers. Tech layoffs are a primary reason why home prices in technology hubs fell 0.77% from June to July of this year. Over 32,000 people have been laid off from U.S. tech companies so far this year. Tech companies that boomed during the pandemic are seeing dramatically falling revenue. This is especially true of tech companies in e-commerce, real estate and those closely related to the stock market. Tech companies doubled layoffs and hiring freezes in 2022 as compared to 2021. Hiring freezes and layoffs have impacted just about every corner of the tech industry. This includes young Web3 hopefuls, established steaming giants, and just about everything in between. Tesla laid off 229 autopilot workers. Netflix cut 300 employees. Coinbase cut 18% of its workers. Robinhood cut 23% of its employees. But experts say that many tech employees are well positioned to find new jobs just weeks after being laid off. And as of June, 64% of tech CEOs say it is getting more difficult to hire the right talent. Despite the layoffs, many open positions remain unfilled. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.